Welcome back to the Neuro Finance Masterclass. Today, on day 124, we master the statistical armor of market volatility. Listen closely, because what we're about to decode today, it's going to fundamentally change how you view market chaos. You're well into phase 2 of our macro journey now, and it is time to take absolute control of the cycle. We're going to strip away the emotion of trading and replace it with pure, unyielding logic.
Spot on. Think about it. Yesterday, on day 123, we unmasked those invisible horizontal support structures using the volume profile, right? But today we're elevating our technical architecture to a whole new echelon. We're going to wrap your trading strategies in an absolute iron shield of mathematical probability. We aren't just looking at charts anymore. We are dissecting the very heartbeat of market expansion and contraction.
Okay, let's dive into this tactical roadmap. We'll kick things off with the statistical shield, move right into the mathematical foundation, and then hit our core setup, the Bollinger Squeeze. After that, we'll talk about navigating the fake-out matrix, and finally, wrap up with your mandatory cognitive task, the volatility audit.
All right, jumping right into Section 1, the statistical shield. This is all about replacing pure chaos with predictable statistical expansion.
There's this profound, almost psychological difference between how an amateur and a true architect faces market volatility. One is operating entirely out of fear, and the other, pure mathematical certainty. Look at this stark contrast here. The amateur views volatility as this chaotic, unpredictable enemy. It triggers their emotions, it makes them over-leverage at the absolute worst possible times, and boom, it liquidates their accounts. But the architect? The architect knows volatility is cyclical. It's not random, it breathes. It moves systematically from periods of extreme calm to violent expansion. We don't fear the chaos. We use our statistical shield to map it and, frankly, to conquer it.
Moving on to Section 2, the mathematical foundation. Let's get into the actual mechanics of this dynamic statistical envelope.
So it's time to leave the theory behind and dig straight into the hard, undeniable mathematics of the market. We're mastering a legendary tool created by John Bollinger back in the 1980s, Bollinger Bands. This indicator is a total masterpiece because it actually constructs a dynamic statistical envelope directly around price action. It's powered by a central simple moving average and then overlaid with volatility bands that literally adapt in real time. It's absolutely brilliant. It takes that invisible, floating market momentum and turns it into a visible, quantifiable boundary that you can actually trade against.
Let's break down the 22 institutional standard. There are 3 crucial lines you absolutely need to memorize. First up, the middle band, or as we call it in Turkish, the orta band. This is your standard 20-period simple moving average, straight from our day 119 lesson, and it acts as your base equator. Next, the upper band, the üst band. This one takes that 20 SMA and adds exactly 2 standard deviations. Finally, the lower band, the alt band, which is the 20 SMA minus 2 standard deviations. These are not just some arbitrary trend lines drawn by hand, guys. These are precise statistical measurements calculating the exact dispersion from the mean price. And here is the massive statistical reality that should literally change your entire perspective on charting. Because standard deviation measures dispersion, bell curve statistics dictate a universal truth. 95% of all price action will occur strictly inside these upper and lower boundaries. Just let the gravity of that number sink in for a second. 95%. The market is mathematically trapped inside this envelope the vast majority of the time.
So what does this all mean? Well, the crucial point is this. Touching those outer bands is not a simple buy or sell signal. I really need to issue a heavy warning right here. Do not make the amateur mistake of blindly shorting an üst band's touch or buying an alt band touch just assuming it's going to automatically reverse. When the price rides those outer edges, it means the asset is executing an extreme mathematical outlier move. It's running red hot, it's a statistical anomaly breaking out of the 95% norm, and you have got to treat it with maximum strategic respect.
Which brings us to Section 3, the Bollinger Squeeze, also known as the calm before the storm.
This right here is the absolute centerpiece of our strategy today. If you truly want to master market timing, this is the tactical concept that's going to get you there. To elevate your quantitative neurofitness, you have to stop chasing price when volatility is already running hot. Instead, you need to become a predator. You need to hunt for the Bollinger Squeeze or the Bandt Duralimus. This incredible setup happens during those long, incredibly boring sideways consolidation phases where, honestly, retail traders just fall asleep. Volatility drops to extreme lows. Mathematically, the upper and lower bands compress so tightly toward the middle band. Visually, it's like a massive, coiled steel spring, just storing up an unbelievable amount of kinetic energy, waiting for a trigger.
The logic of this timeline is just flawless. The volatility cycle always flows in this exact order. We start with extreme calm, that's your consolidation phase. Then comes the tightening, the actual squeeze, the ventandata massa. And finally, inevitably, the violent expansion, which is your breakout. A true architect knows that this historical compression is literally the single most reliable precursor to a massive multi-week volatility explosion in the market. You find the calm, you track the squeeze, and you position yourself way ahead of the herd.
I actually want you to write this down and internalize it. The longer the squeeze lasts, the more violent the eventual breakout expansion will be. This is the ultimate reward for your patience and discipline. When that coiled steel spring is held down for weeks, maybe even months, the mathematical snapback is going to be absolutely parabolic. The market just cannot stay compressed forever.
All right, Section 4, Navigating the Fake-Out Matrix. It's time to talk about surviving market maker manipulation.
But of course, there's a trap, and we must be hypervigilant here. This is the danger zone of the setup, so we are shifting into intense, uncompromising risk management mode right now. Market makers know exactly what you're looking at, and they will actively hunt you with a head fake, what we call a Yolandi kickish. This is a predatory, engineered volatile spike that briefly breaks below the lower band. Why do they do it? Simple. It's designed specifically to grab retail stop losses, which we talked about back on day 95, and to panic amateur short sellers into the market. And the very second they sweep that liquidity, bam. They instantly reverse the entire order book and launch a massive, parabolic bull rally straight out of the upper band. It is ruthless, and it literally happens all the time.
Look at how our two archetypes react to this manipulation. The amateur, they see the bands tightening. They impatiently wait for the very first candle to pierce the upper band, and they immediately jump in with high leverage. Naturally, they get completely chopped up by the Yolandi kickish. But the architect operates on a totally different frequency. The architect protects their capital with cold, calculated patience. They wait for a decisive, undeniable candle close completely outside the squeeze zone before committing a single dollar.
And this brilliantly illustrates exactly how we stack our advantages. Here is the architect's validation checklist to confirm the breakout is actually real. Number 1, we need that decisive daily candle close outside the squeeze zone. Number 2, we cross-reference that with expanding on-balance volume, applying our masterclass lesson from day 122. And number 3, we look for an accelerating MACD histogram, bringing in day 121. See, we mathematically validate the true breakout direction, we do not guess, we let the market structure prove itself.
Finally, Section 5, the volatility audit. This is your cognitive task for today. This brings us to your final tactical deployment. It's time to take everything we just decoded and immediately apply it to your charts. I need you to move from passive listening to active execution right now. Just follow these exact operational steps. Step 1, open TradingView and apply the standard Bollinger Bands, configured strictly to 20 and 2, to your core crypto or top stock index on the daily time frame. Step 2, scan back in time to find historical periods where the bands compressed into a razor-thin neck. Really hunt for that historical drama. Step 3, observe the massive multi-week price velocity that occurred immediately after that expansion opened up. Validate the math with your own eyes. And Step 4, audit your current active holdings right this second to see if they are overexpanded or silently tightening.
I'm going to leave you with this final provocative challenge. Look closely at your portfolio today. Are your active holdings currently overexpanded and exhausted, sitting dangerously on the outer bands? Or are they silently tightening into an explosive new fuse, preparing for the next massive move? It is time to stop getting caught off guard by volatility. Audit your deviation brackets, anticipate the squeeze, and rule the cycle. I'll see you back here tomorrow for day 125 of the masterclass. Keep your shields up.